back in the 70s, bank loan creation was the biggest source of money supply growth, and fiscal deficits were a smaller portion, and federal debt to GDP was low. But today, bank lending was not excessive at any point during these inflationary spikes, whether the post-COVID inflation or whether this inflation is not because of excessive bank lending. But you do have well over 100% debt to GDP, and when you raise interest rates, you actually blow out the federal deficit more than you slow down total bank lending. So we're kind of through the looking glass on monetary policy.
It's kind of interesting. We were taking sort of a pivot here recently, and we're talking more about equities. And I've talked to quite a few people about this pivot, and the feedback I get is a bit surprising to me, because what they're telling me is that that's all fine and well, but please keep on bringing Lyn back to talk about macro. And that's kind of like, whenever you hear that from someone who's very micro, and you're sort of like, especially if you come from the church of Buffett and Munger, you're supposed to say, oh, we don't want to hear about macro. So whenever hardcore value investors are telling you, yes, but still, please talk to Lyn. That's, at least in this echo chamber of value investing that I'm in, that's the highest of the praise you can get.
Of course, and I think it's a symptom of the age we're in. I've been describing this as a macro-heavy decade. And so the advice to either ignore macro or include macro can vary much depending on the times. I think to Buffett and Munger's point, I think during that 4 decades of falling interest rates, from the early 80s all the way up basically to, to the global financial crisis and thereafter, really to 2020 in some ways, you could mostly, if you're in the US at least, you could mostly ignore macro, focus on value or growth or reasonable price investing, or even passive, and just do exceptionally well. And I think really only in this kind of age of fiscal dominance, massive liquidity injections, record tightening of central banks after those injections, and then geopolitical issues and things like that, macro has kind of inserted itself whether we like it or not. I think it's useful to have it as an overlay more than we needed it, maybe in the 90s, for example. So yeah, I think different advice for different ages of time.
Well said, Lyn. And so jumping into the first question here, I have to start talking about gold. Gold is traditionally seen as a geopolitical hedge, but we are also looking here at the current Gulf War. And so the price of gold, initially it soared and then it plunged. And at times it's behaving more and more like a risk asset, Frank. So how should investors think about gold here? Is it still a reliable hedge? What role does inflation expectation have and real yields? That is what we traditionally look at whenever we look at gold.
Yeah, it's a great question. I think a couple things. One is the tricky thing about hedge is a hedge implies it pays off kind of the moment you need it to. And gold is not necessarily a hedge in a way that, say, a put option might be. If your goal is to pay off when equities go down, a put would do that specifically, whereas gold, it's its own thing. It's a hard money. It's a very, old asset. It has its certain properties. Those properties tend to give it risk-off characteristics and safe haven characteristics, but it's not quite a hedge in the sense that the timing is not always what people expect. Similarly, during the March 2020 COVID sell-off, gold went down, not as much as silver, not as much as stocks perhaps, but it did go down. When you have kind of a dollar shortage and a short squeeze, almost everything goes down compared to the unit of account that debts are denominated in. I wouldn't really rely on a timing basis. And I think for this particular crisis, it's a symptom of fast money. So I wouldn't overthink gold's kind of general safe haven status just because it didn't perform well this time. Because when you look at the 18 months leading up to this war, there was a massive bid for gold. We had like record overbought, let's say you look at weekly or monthly like RSI, just overbought status on most technical indicators for gold, silver was like top 1% of looking at the past century, right? So you have all this fast money in it, a lot of enthusiasm. And so when a war hits, it's easy for fast money to just go elsewhere I think the bubble was already kind of breaking, or at least I don't think they're fundamentally in a bubble, but I think there was like a technical bubble, a kind of a local bubble forming. And that I think was breaking pre-war, and the war didn't help it. Whereas ironically, Bitcoin is often seen as risk on, and it sells off during crisis and actually held up oddly well. Sometimes I get the question, is it a risk off asset now? Is it a safe haven? I say, well, I wouldn't overthink that either. I would not make that claim because I think it's a simple fact that there was no fast money in it, or most of the fast money was already out. It already had a terrible 6 months leading into the war. And so there's really no kind of flighty capital to go anywhere, unlike gold and silver that had plenty of fast money. And so sometimes a 6 to 18 month trend or cyclical trend can interfere with what is otherwise kind of a structural truth. And then for the real interest rates phenomenon, I think the most interesting part of the question is for a very long time, gold traded on real interest rates, meaning that, you look at its main comparison to the dollar or short-term treasuries, and you say, okay, we can get this much on treasuries. Here's inflation. And so if you can get a positive real rate, you say, well, I can hold gold and get paid nothing or even pay something to store it securely, or I can get paid on this. But during ZERP, for example, when you're getting paid zero, but there's still inflation, you have a negative real rate. So everyone's like, I might as well hold gold then, and you bid up the price. What's interesting is that we've had a dislocation where despite positive real rates, gold has done very well. So it dislocated to the upside. And I think a big factor for that is fiscal dominance. I think the fact that the US is in structural fiscal dominance, that's kind of like changes the nature of the game because the main difference there, so back in the 70s, bank money lending, bank loan creation was the biggest source of money supply growth, and fiscal deficits were a smaller portion, and federal debt to GDP was low. So when the central bank, when Volcker jacks up interest rates super high, it slows down bank lending. And while it does blow out the fiscal interest expense a little bit, when you have low debt to GDP, that's a smaller factor than how much you just slow down bank lending. But when you fast forward to today, bank lending was not excessive at any point during these inflationary spikes, whether the post-COVID inflation or whether this inflation is not because of excessive bank lending. But you do have, well over 100% debt to GDP with large demographics driven deficits. And when you raise interest rates, you actually blow out the federal deficit more than you slow down total bank lending. So we're kind of through the looking glass on monetary policy. And I think gold market has sensed that out. That's probably the key reason why we've seen gold do well despite positive real rates, because positive real rates don't really slow things down the way they used to.
Thank you, Lyn, for calling that out. I think it's such an incredible, important topic. And I'm worried, and of course, I can't speak for all our listeners, but I am worried that quite a few of our listeners are just not thinking about fiscal dominance because, as value investors, we're sort of like trained to put some things in the too hot pile. And that's probably okay if you're looking at this obscure mining stock and you're like, oh, that's just too hard. But like, you have to pay attention to what's going on with fiscal dominance right now. And I just wanted to mention, I really like how you also talked about the time horizon. Like whenever people are talking about, like me, does it behave like a risk asset? And you're like, yeah, but whenever we talk about hedge, it's not like if you need the money tomorrow, like that's not the time frame at all we're looking at. So I'm really happy that you called that out. I wanted to talk about that some countries, they're under a lot of pressure right now with the higher energy prices, and they might need to mobilize reserves. Now, to which extent could energy shocks lead countries to sell gold or otherwise use gold as liquidity source? And how does that affect gold's role as a reserve asset, if any?
Right. So when we think of reserves, there's different types of reserves for different purposes, which is to say that gold is often the reserves that countries don't plan on selling, ideally ever. I mean, it's slow to sell, especially if they have it in their own custody. If they have it in New York and they can just do a phone call and have it transferred to someone else's box, that's one thing. But if they actually hold gold tonnage in their own, central bank vault, selling it's not the quickest, easiest thing. That's what treasuries and dollars are for and other currency holdings. They can sell those very quickly. And so generally speaking, you would see a trimming of other reserves before you would see a ton of gold tonnage. I mean, around the margins, you can always sell some. And then there's the fact that there's all these mechanisms in place now, especially post-COVID, like foreign repo facilities and stuff, where entities like central banks can get liquidity without selling reserves. They can just pledge their reserves as collateral. So for example, in the US, we have the FEMA repo facility, is specifically for foreigners in addition to our domestic repo facility. And so let's say a Gulf state right now is in financial trouble. They want to keep their currency pegged, but they don't really want to just fire sell treasuries. That could disrupt the treasury market. And two, I mean, they're kind of like responding to what is hopefully a temporary problem with a permanent sale. So one thing they could do is put those treasuries or some of those treasuries in that facility, get dollars, and they're just using their reserves as collateral for liquidity. And then, should the crisis resolve itself and their cash flows get better, they pay back those dollars, they get back their treasuries, and they didn't have to sell those in the market, potentially impair the price of their own assets and all that. Because, during COVID, when cash flows just instantly dried up in the span of a week, it's like the whole world has changed. And yet all those debts, all those cross-border debts are still owed. All these indebted entities are in trouble. And, there's a scramble for dollars. And then there's a rapid fire sale of treasuries. It actually broke the treasury market. It's supposed to be the most liquid, deep market in the world. And yet many off-the-run treasury markets just kind of went no bid. And so these types of facilities are kind of set up to avoid or minimize those types of problems. So I think that a lot of countries have options before they would resort to selling gold tonnage. Although, of course, if gold soars, maybe they want to rebalance, right? So there are some reasons why they might want to sell gold, but I don't think most of them have to anytime soon.
Yeah, I'm happy you say that. Actually, I wanted to talk about Eigengreen's new book here later, but I can't help but mention now he has this amazing story about how Maduro is chartering a Russian plane, sending it to Africa and selling gold bars. Once you just buy the book just for that story alone, it's quite extraordinary. It's not as simple as it sounds, and it probably already sounds pretty complicated. Anyways, I wanted to ask about gold sensitivity to real yields and its role as a reserve asset. Now, how should investors think about gold in a world that may be moving more towards fragmentation and less reliance on the US dollar?
I think a couple factors. One is, as you just said, as we kind of enter fragmentation, there is value in holding your own asset in self custody, whether it's an individual or in this case, a sovereign. I mean, it's like, are you truly sovereign if 100% of your reserves are held by another country and can be frozen by that country? So if you hold any securities, whether it's government bonds, equities, corporate bonds, or bank deposits or central bank deposits, all those assets are basically types of securities or security adjacent, and they can just be frozen with a stroke of a pen by the country that oversees their issuance. Some countries will hold gold, but they'll have it in another jurisdiction. They'll hold gold IOUs. And again, they can just be like, well, they're frozen now. Thanks for playing. Whereas if you hold gold tonnage in your own jurisdiction, nothing short of like war can come and get your gold, right? So it's a form of kind of defense. So is diversifying your reserves so that at least your IOUs are spread out between more than one jurisdiction. Some of those jurisdictions might not like each other, so they might not agree to collectively freeze your reserves. So I do think that that's a really big component. And then two, instead of real rates, I think it's best to think of them in terms of dilution rates, which is a higher hurdle. So when we look at real rates, people will look at what interest rates are, say, treasuries paying versus forward kind of break even inflation expectations as measured by like the TIPS market, for example. That's a common way to do it. I think a better method is to look at money supply growth for the jurisdiction in question, let's say the US. So in the US, money supply growth is historically above inflation levels because we have technological productivity increases that offset some of that money supply growth. So let's say every year, money supply grows by an average 7% a year. We get 3% more efficient at making stuff. And so over the course of a long time, we have something like 4% inflation. Obviously, it's bumpy. Sometimes we have double digit inflation. Sometimes we have sub 2% inflation. But let's say it averages to 4. Real interest rate market would look at that 4%, whereas the actual dilution rate is at 7%. If the money supply is growing by 7% and you're holding treasuries that are paying you 3 or 4, you're getting diluted by 3 or 4% a year in terms of like your share of the overall dollar network. Whereas when you look at gold on average, according to most estimates, grows in supply by 1 to 2% per year. So around 1.5% on average. And so that's your dilution rate, 1.5%. Whereas if you're holding T-bills at 3% and the money supply is growing at 4%, 7%, then you're getting diluted at 4%. And again, in a timing sense, that might not matter in a given year because a lot of money could rush into gold and rush out to gold. So you can get a 20% drawdown on gold and be like, well, how does that help me when we're talking about a couple percentage points of dilution either way? But over a multi-year, multi-decade period, that really accumulates. So I think from an investor standpoint, whether it's gold, whether it's real estate, whether it's cash and bonds, whether it's even equities, you kind of want to look at always, are you getting diluted or not? And you want to kind of gravitate toward assets where you're not really being diluted. For equities, it gets a little bit more complicated than that, but that's a general principle that both individuals and central banks, I think, are increasingly going to factor in.
Whenever you look at financial history, and I can't help myself looking at that, and you look at, for example, what happened after the Dutch Empire fell, and there were quite a few countries who said, oh, by the way, now we don't owe you any money because they know that the repercussions of doing it versus what repercussion of actually paying the money would be. And so they basically just said, it's just not valid anymore. Do you see treasuries being weaponized that way with growing conflict? I know some people say it's already happening, but you could be way more granular about how to weaponize T-bills than what you see right now.
Yeah, I think, whether or not it happens, all countries have to consider the possibility of it happening now, right? So that's the first order thing is like, you can't just wait till it happens. Again, going back to the question, are you sovereign if all of your reserves are in question, or at least a really big chunk of your reserves? So the less of your reserves can be frozen with a stroke of a pen or otherwise impaired, the more options that country has. And so, I mean, obviously the main risk is just freezing or confiscation. No one really blinks their eye when like it happens like Afghanistan, the Taliban take over and we're like, okay, those are not really your reserves. No one's really going to care, other than obviously the Taliban. Whereas when it happened, when Russia invades Ukraine, it's a big enough entity that kind of multiple other entities are like, wait, their reserves can be, frozen. And then you can imagine another level where the US, especially because we're kind of erratic recently. We're talking about invading Greenland potentially. We're doing all sorts of stuff unilaterally. We could have a president that says, we want to seize their reserves unless they give us Greenland or unless they agreed to let us do XYZ, unless they agree to have a base in there. So there's steps that go along the route. And I think before you get to those extreme situations that might or might not never occur, countries have to consider the possibility of those extremes. In a similar way, I mean, if like Canada, when it was constructing pipelines or just choosing whether to allow certain pipelines or block them, they kind of made themselves very dependent on the US. And if the US says, we're going to use the fact that you're dependent on us now, that puts them in a really rough situation. So then they scramble to say, hey, all these pipelines we kind of put on hold. Maybe we should re-explore those to have options on where to send our energy efficiently. The same thing happens with the reserves. The same thing happens in multiple fields. And I think we had kind of a long stretch of kind of a unipolar world, especially after the fall of the Soviet Union. Call it a 3-decade stretch of kind of peak globalization. Countries and companies could optimize for efficiency over resiliency. Just-in-time supply chains, just assuming the global order is kind of clean and it's not going to change much. Whereas now, resiliency and backup plans and negotiating power and resilience against just being impaired by a stroke of a pen is more important for years and decades in the future.
Interesting times, definitely. I want to talk a bit about the framing here of the dollar because I think many of us, and perhaps it's my own bias, but I certainly benefit from a strong dollar. I earn in dollars, I hold dollar assets, my expenses is effectively in euros. And at the same time, we hear more and more about structural risk of an overvalued reserve currency. So if we strip away any thoughts of patriotism, whatever we want to call it, we just look at incentives. Now, who actually benefits from a persistent strong or overvalued dollar, and who is effectively paying the price for it? And we can talk about this globally and perhaps even within the US with the K-shaped economy than some people talk about.
It's a really good question. So I think first we back up and say kind of how does the reserve currency work and how does it get overvalued? So most currencies around the world that you don't have to own but could own as a trader, like if I want to buy or sell Egyptian pounds, for example, you'll look at it and say, okay, is that country running a trade surplus or a trade deficit? Is its economy growing or shrinking? Is it a place where capital wants to go into? Are they confident in the rule of law? They want to go invest in their equities, their real estate, and therefore kind of prop up that economy. Or do they want to pull capital out? And then their interest rate differentials. If I just hold their currency, am I getting paid a rate? Going back to the real interest rate question, am I getting paid in line with the money supply growth or the expected inflation rate of that currency or not? And so all these currencies will trade on each other based on principles like that. And their central banks can respond accordingly with reserve purchases or sales or interest rate changes. And the dollar is no different to start with in the sense that it does trade on all those things. That's why it has big cycles over time. But then in addition to all those normal factors, there's also just a structural bid for the dollar that's almost inflexible. And it's because, unlike Egyptian pounds, where you can choose to hold it or not, it doesn't really affect you that much. Dollar is the biggest network effect in town. It's the main one that most currency trading pairs are traded in. So there's not a lot of liquidity between Egyptian pounds and Korean won. But if you want to go back and forth, you trade one for dollars and dollars for the other. And that's true for hundreds of different currency pairs. In addition, when a country's going to hold reserves, we talk about they can hold gold. Gold has some volatility to it. It's also slow and clunky, it's sending it over in planes sometimes if you're literally doing the whole self-custodial route. And dollars are very efficient. They're kind of the most liquid, reliable bond market in the world. And also dollars give you access to kind of the broader US equity market, US real estate market, very big, diverse, deep market compared to Europe's kind of more fractured market. So same currency, but fractured bond market, fractured equity market. China with the capital controls and just smaller market in general, despite the size of the economy. And so there's a structural bid for dollars. And what that does is that overvalues the dollar based on its normal kind of trade characteristics that we would normally look at, like the ones I previously discussed. And it makes it so that Americans have way more import power than we otherwise would have, but our export competitiveness is harmed. And it kind of starts with the lower margin stuff, right? So it doesn't really impact our super high tech. If our currency is 20% overvalued, it doesn't matter if we have like the leading semiconductor chip in the world. The people are going to buy it anyway. Or a pharmaceutical that's super high margin and cures cancer. Whereas like our low margin metal thing, right? That's the thing that's like, okay, we're going to stop building that in the US. We're going to go build that in China and Vietnam and elsewhere, even parts of Europe, even Japan. Those places can still produce this stuff. And another way of thinking about it is if the whole world uses dollars, they need dollars, right? So there's trillions of dollars floating outside of the US. It's like, well, how did those dollars get there? And the answer is structural trade deficits. They overvalue our dollar, and therefore we run trade deficits with the rest of the world for like 50 years straight and supply them with dollars. And over time, that builds up major imbalances. And that's a long way of getting to your initial question of who wins and loses from it. So that for the most part, the winners are those who are in the dollar or dollar security export business. So the US government wins because their currency is overvalued. They can run big fiscal deficits and they won't have a Liz Truss moment, or at least the Liz Truss moment is much harder to get when there's all this structural bid for dollars. So they can do more COVID stimulus without kind of really paying as much of a price as many other countries would. They can have 800 foreign military bases. Their energy is priced in a currency they can print. Americans don't have to think about exchange rates. There's all these advantages. If you're in New York and you're selling securities, you're investment banking and things like that, the whole world wants your securities. If you're a corporation selling bonds, the whole world wants your bonds if you're in the US. In Silicon Valley, you're selling private securities essentially. The world wants those. And so if you're in the dollar or dollar security export business, so basically government or finance, you're doing great. If you're high tech or high margin in general, so pharmaceuticals, tech, you're kind of neutral to good. You're doing pretty good. You don't really not impaired by it. And then if you travel the world, it's nice to have a strong dollar and you get all the kind of the privileges without really the downsides. Whereas it hurts those that are more in the manufacturing or lower margin businesses, which is like the Midwest area and in general, just the whole segment of the population that even supports those. If you were running a restaurant next to a manufacturing town or in a manufacturing town, you're by extension impaired as well. So both sector and geography. Now, the tricky thing is that the further this goes, the more imbalanced it gets, it can actually start to harm some of those winners too. Like if our industrial base is so kind of stagnated that the military can't replace its production as quickly as it could, decades ago. So like we can only make so many interceptors, for example, in a given month. It actually starts to impact the government in a way too, or those in more in that dollar security or military industrial complex. And so if it gets imbalanced enough, it can impact almost everyone. But for the most part, there's that pretty clear segmentation of winners. So having the dollar as the global reserve status really is good for like America, the empire, or America, the coasts, America, the finance hubs. And it's really not great for America, the heartland, America, the industrial powerhouse that we used to be. Those are generally on the losing side of that arrangement.
Lyn, I want to talk a bit more about winners and losers, and perhaps I'm making it a bit too black and white, but I do like, probably because I'm a trained economist, but please don't hold it against me. But I kind of feel like there's something to be said about making it a bit more simple and then sort of like start building on the thesis. And so I'm going to use that as framework to talking about the investment case we have here for energy and oil equities, and that's something you talked about in the past, and you've been right about that. But if we just stay with oil here for a moment, we have a current oil shock, and that redistribute economic power to some extent. So could we simplistically say who are the winners and losers from this so far, and both across country level and then across sectors, and then perhaps build on that?
Well, so on average, if a country is a net exporter of energy, they're doing better than if a country is a net importer of energy. Sometimes that gets oversimplified in media because, if you're in a country that is a net exporter of energy, it might not be as bad if you're in a net importer of energy, but your energy bills are generally still higher unless that country is, say, subsidizing its own energy with its own production, like a little bit more of kind of a socialist kind of energy situation. So barring that, in America right now, I mean, energy producers are doing fine. We're kind of there's talking points about how all the world's going to buy our energy. I mean, it's not like we have a ton of spare energy just sitting there, right? So that I mean that bids up our prices. So if someone is in America but doesn't work in the energy industry, they're not really getting any benefit, and they're paying higher energy at the pump. By extension, they're paying higher diesel prices because if these things persist, stores have to raise prices on all the goods they transport around on trucks and trains and all that. Higher tickets to fly on an airplane anywhere, whether domestically or internationally, and higher rates of cancellation on flights because all these unprofitable flight routes are canceled that they don't think they can raise prices enough. And so, for the most part, the vast majority of people do poorly when energy prices are higher. There's relatively few winners, those who produce them, those who invest in them, and there's some that are just kind of doing damage control by being in a country that at least is not going to have shortages, is going to be somewhat self-sufficient. But the vast majority of consumers globally, including in those exporting countries on average, don't really benefit from higher energy prices. We generally want our raw inputs to be as cheap and abundant as possible. And whenever there's bottlenecks or shortages or high prices in those raw inputs, that's when you get a lot of problems.
Yeah, and I think it's also really important to be talking about nominal and real numbers. I think we all as consumers have this natural tendency to be looking at nominal numbers. Just it's easier to relate to, like you things are expensive. I know I'm not telling our listeners something that they don't know, but I think I want to use that transition to the next question about how the daily lives look different from the average U.S. and Egyptian consumer. At the time of recording, Brent is trading 110. So, but originally I sent you the question asking you, how does the daily life look like whenever it's 100 and 150 in those two countries? Call the average. I know the average doesn't exist, but that's sort of like the primer.
Yeah, good question. So, zooming out for a second, I think the world can take $100 to $150 oil. It's not comfortable, especially when you get there very quickly, like we have. But especially on inflation, you point out the difference between nominal and inflation adjusted or real. I mean, this is it's not record oil prices on an inflation adjusted basis. If anything, ironically, the gold to oil ratio, like oil's cheap compared to gold, and that's kind of absorbed all this kind of decades of money printing into the gold market. And so both, from multiple ways of looking at it, it's almost like $100 plus oil's like a new baseline in a sense. Like that can encourage new production. That's kind of a reasonable balance, or at least the high double digits. $60 oil is, I think, not that sustainable because producers can't really make money down there for the most part. And so I think the world can, after some period of turmoil, absorb 100 to 150, even maybe a little higher energy prices. The higher you go from there, and even at that level, poorer countries on average are going to be impacted first. So Egypt has something like 1/20th of the GDP per capita as the US. Now, when you factor out kind of wealth concentration, you say, okay, what about the median? It's still something like 10x or more, right? So the median American has just way more buffer or purchasing power. Same thing with the median European, the median, XYZ. And so higher prices at the pump are bad, but they're not as catastrophic. In Egypt, for example, they just had a month-long energy curfew, right? Because their natural gas import bill tripled. When everyone's kind of scrambling for LNG, Egyptians can't outbid Europe. They can't outbid China. They can't outbid, wealthier countries, Japan. And so they're more likely to just get acute shortages. Basically, you can't outbid the prices, so you just get less natural gas to deal with. And so they start doing energy curfews. So the shops and cafes and stuff will have to close at a certain time, which is especially tricky for a desert country where more economic activity happens on average later. So closing at 9 p.m. in the suburbs that I live in here, people will be like, wait, things are not open anyway after 9, right? But in Cairo, that's a massive change. Now, the good news is it has eased a little bit there. So they've actually they're ending their energy curfew because it's obviously very unpopular. But there's a risk that it could come back because, energy prices have kind of chopped a while. But if they keep soaring, you could see this happen again. And so, on average, developing country citizens are more impacted. But it's also, I mean, in the US and Europe, I mean, in the US, for example, stocks are near record highs, but consumer sentiment is literally at record lows. Like since it's been measured nationwide, going back to like the 50s. So in like 70 years of data, I mean, this is like the going through the late 70s malaise, going through the global financial crisis, going through COVID. Those were all low points. This is somehow even lower because people are working full time and yet having trouble making ends meet and not really being confident in the direction of things. And so it impacts negatively almost everyone. But yeah, I think the world can absorb 100 to 150 nominal oil prices, even though it's unpleasant when you make that transition.
It certainly is not pleasant. I wanted to ask you about the relationship between public debt that we talked a bit about before, and then social unrest, and then perhaps go back to the gas prices afterwards.
Right. I mean, when you have high public debt, it's a symptom that things have not been in balance for a while. So often aging demographics, sometimes war, but often just aging demographics. And in the US's case, we have just kind of a couple things are kind of happening at once. We have record kind of payments to the older generation compared to the younger generation, which is on average backwards from how you generally think about kind of investing in your future. So we're kind of fueling older consumption and we're not really like education or families buying their first house to start a family. Those things are all just really expensive and kind of left for, it's challenging. And so you start to get more just turmoil. You get intergenerational warfare, or you get more polarization because everybody feels something's wrong, but no one's sure why. So you get cross the aisle kind of finger pointing and just a more extreme decision making in general. And a big part of whether a person or a company is doing well starts with the question, are you on the right side of fiscal deficits or not? Right. So if you're in the business that is either receiving deficits or caters to those that are on average receiving deficits, you're probably doing pretty well right now. Whereas if you're in a business that is not really on the receiving side of deficits, and if anything is a little bit harmed by tight monetary policy, if you're a realtor right now, right? So no one wants to sell their homes because they locked in their 3.5% mortgage. No one really wants to buy a home because they don't want to pay current mortgage rates and they can't really afford the high prices mixed with high interest rates. So turnover is very low, even though there's not been a collapse in real estate prices, but this turnover just has collapsed. So if you're in the business where you depend on volumes of real estate turnover, you're out of luck. It becomes kind of very binary in that sense. Of course, the other variable unrelated is AI capex spending. It's so big these days. So if you're on the right side of kind of fiscal deficit or AI capex, you're on the good side of the economy. And if you're on the losing side of tight monetary, or at least not on the receiving side of fiscal deficits, you're impaired. And that, of course, leads to all sorts of political polarization. Instead of just kind of, when there's kind of that strong of a thumb on the scale, there's bigger debates on where that thumb should go versus if that thumb was smaller. And then, like I said before, when you have over 100% debt to GDP, and if, like in the US, annual fiscal deficits are bigger than all bank lending combined on net. So that the sum of new bank loans year over year is smaller than the annual fiscal deficit. And even net new bank loans plus corporate bond issuance, that's roughly the same size as the entire federal deficit. And so when you get that much kind of public debt to GDP and those large deficits, when the central bank says, okay, we want to slow stuff down, we want to slow credit formation, slow money supply growth, so we're going to raise interest rates. The problem is you do slow down that private sector stuff to some extent, but then you blow up the fiscal deficit by an even bigger number. So you actually, in some ways, accelerate total credit growth by raising rates. And that's a state of fiscal dominance that Japan's been in for a while, and the US has kind of more recently entered.
It would be odd if we had an episode together we didn't bash democracy, or at least I didn't bash democracy. And again, I always invoke this Churchill quote that it's, what is it that he's saying? Like, it's terrible, but it's not as bad as the others. But it was quite interesting. For example, we had this spike in oil prices whenever we had election going on. I'm based in Denmark. So there was election, then oil prices spiked, and then all parties went out and said, oh, price control. And because that's how it works in a democracy. And especially if there's an election, why wouldn't you want price control? And first they were thinking would say, okay, why wouldn't we have $3 cap on gas at the pump? Like, why not? Like, isn't it better if it's $3 and it's $4? It certainly shouldn't be $5. And so, of course, in economics, you always have to ask, and then what? And so why is it not as simple as just saying, let's just lower whatever, let's just call it $3 because then people are happier. Why doesn't that solve all problems?
Well, the short answer is because you're more likely to get shortages. So generally speaking, when you have an energy shortage and prices are going up, if you let prices going up, people can still get it if they're willing and able to pay the higher price. So it provides an economic incentive where if you're kind of using energy superfluously, you're more mindful of your energy usage. So you reduce non-essential energy. Energy still finds its way to the kind of the most essential areas or those willing to pay for it. And by extension, I mean, there is a somewhat unfair thing. If you're wealthy, you can just pay for it frivolously. Where if you're poor, even for essential stuff, you may have trouble paying for it. But at least it's still kind of getting on average to more important things. Whereas if you just do a flat kind of price cap, there's less differentiation between essential stuff and non-essential stuff. And two, it kind of prioritizes, instead of wealthy versus poor, prioritizes who gets there first. Because if you only have so much energy to go around, the price is not going up, so no one's rationing it. So whoever gets there first gets it. Or the government says, okay, your license plate can get gas on these days, and your license plate can get gas on these days. So you have more government control in things. And then two, we talked before about how wealthy nations can outbid poorer nations. So if you have a region that's doing price controls, well, those places are not going to outbid other places for energy. So if there's a limited amount of LNG or other types of fuels that can go certain places, those places that are willing to pay higher prices and able to pay higher prices are going to get that extra supply. And then even more structurally, if it stays elevated long enough, that's a signal to producers to produce more of it. Whereas if the price is kind of artificially suppressed so that producers aren't making money at that price, like there's a shortage, but there's an artificial price cap, producers will say, well, we're not going to produce more energy because, one, if we make a lot of profits, they're going to get windfall taxed away from us because we're the bad guys right now. Or two, there's going to be price controls that prevent us from making those profits in the first place. So we're not going to take the risk of developing a multi-year project for new energy. And so price is a mechanism of coordination, often without the parties even knowing each other. Just like if you say, okay, we're short energy, we're willing to pay more for it, who's a seller? You find sellers. And this price controls kind of distort that.
If you spend any real time investing, you've probably noticed something. The longer you do this, the smaller the circle of people you can actually talk to about it with gets. Most people in your life are, unfortunately, not spending their weekends reading 10Ks. And the internet is full of noise, as we know, hot takes, meme stocks, influencers with a camera and a conviction that they can't defend. Well, that's the gap that the mastermind community was built to fill. I'm Sean O'Malley, and alongside my colleagues Stig Brodersen, Kyle Grieve, and Daniel Monka, I help lead a small application-only community of long-term investors who are serious about getting better at this. You'll join a like-minded peer group, enjoy direct access to us as hosts and to high-profile guest speakers on private calls, and live events like roaming Omaha with us during Berkshire weekend. If you'd rather compound your capital alongside people who take investing as seriously as you do, apply to join at theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind. We'd love to have you.
It is such a powerful thing whenever you have price signals. And I think Adam Smith, and now we're again talking about financial leadership, even he said, with the invisible hand and everything, that there are certain things you probably shouldn't rely on your neighbors for. But by and large, if you don't allow the markets to have the market signals, they're not going to behave rationally. So like right now, we see spiked oil prices from whatever kind of basis. And to your point, Lyn, perhaps this is the new normal and we have to define what that means and a long time horizon and so on and so forth. But there is a lot of uncertainty in the market, and it takes a lot of time to ramp up the production. That's just the way the oil market works, for example. And so if we're like, now this is going to happen with with homers or whatnot, and then the next day, no, that's not going to, like, you're like, okay, but if it takes 6 months for us and a lot of capex, and we need to have somewhat certainty before we ramp up production so the oil price can fall, then we can act. So as soon as you start to set those mechanisms out, and you also have companies who are saying, oh, okay, but does that mean that we're going to get a lot of windfall taxes to a point afterwards? Like, so even if we do spend that capex, but then we just still don't make the money because, not just because of the taxes, but also because of what can we then count on, what's going to happen. So I don't know. I kind of felt like I came across as way too political whenever I say that. I probably have too much of a bias to free and open markets, but I think that there is, and perhaps this comes across the wrong way, but I think that there is something very powerful and beautiful about having those free and open markets, because you are fixing a lot of problems, and it probably doesn't look like that at first glance, because why would we want to pay $3 and not $4 at the pump? But there are other reasons why. So anyways, let me throw it back over to you, Lyn.
Yeah, I think free and open markets are kind of like it's like the quote about democracy. It's like the least bad. Is it's like obviously there are winners and losers. There are situations that are tragic, but it's the best mechanism we know of to create prosperity and to efficiently move around resources to where they're needed most, and to encourage the production of more resources that we need, and to discourage the production of things that we already have too much of and that we're wasting labor and money and time on that are not being used, that a centralized system might just ignore those signals and just keep pumping out and things like that. So often, I mean, capitalism will be criticized for environmental damage. It's like, well, look at the environment under Soviet, Russia back then. I mean, that was like so often the case. All the kind of the evils or ills you could point toward free and open markets, it's often less bad than if you don't have those things. And if I appeal to people on the side that kind of wants those price controls or wants the more state intervention, I would kind of point out that the price controls are kind of like among the worst ways of doing it. So it's not to say that government can never be involved in something. They can still set the rules to have a level playing field. You can't have child labor. You have to have certain building codes that don't fall down in a category 1 hurricane. You can set ground rules so that efficient operators are operating in an environment of rule of law with efficient arbitration and all this, and have kind of a level playing field. The government can have a stockpile. I mean, that's the forward way of looking at it, is that when energy prices are cheap, the government can, build a facility and have stockpiles, or it can potentially mandate, like Japan does, that the private sector has to have a certain amount of stockpiles. There's fewer downsides of having those things in place than something like price controls. So there are other ways that the government can help the private sector operate in its most efficient and fair way, and just then price controls. Price controls are kind of the most among the more interfering types that actually can more often be counterproductive.
You can definitely point at free and open markets, say this is a problem and that is a problem, and it's full of so many problems. But to your point, it may be the least bad, and then we have all the exceptions. And I guess depending on where you are in your daily life, then the exceptions that you might lean into are different for all of the listeners. Since this is a stock investing show, I would be amiss if I didn't ask you about, giving the combination of energy-driven inflation and a more fragmented global monetary system, where do you see the biggest mispricings and opportunities in equities today?
I've been fairly constructive on banks and financials because they're resilient against defaults. I mean, they already have pretty high levels of reserves and treasuries and fairly safe assets. Two, they're on the receiving side of fiscal deficits. So a lot of this interest expense is going to banks and financials, and they're pretty cheap. And so I've been using them as kind of a value dividend play, including US ones, Latin American ones, and sometimes elsewhere. I've been long energy. I didn't rush to buy energy because of this crisis, but I've already been long energy and energy pipelines and things like that. I think that eventually software as a service stocks will get to the point where they're dramatically oversold. I think it's nobody wants to be a hero and rush in and buy a falling knife. So it's like people want some sort of either technical bottom or like a signal, or they want to see more signs that these companies' cash flows are not being as impacted as much as the bears think. So it's like, I don't know what that level is, but I'll say it's an area that I'm watching very closely. There's one stock I started to get into probably a little early, and then there's other ones that I'm watching to say, okay, I'm not gonna be premature and just get all my capital in and then be down another 30%. And then, but it's like I'm potentially layering in and at least watching very closely the software space, because I think that the baby will be thrown all out with the bathwater in some cases. I have been on the more growth side. I mean, I have been bullish on semiconductors, even though it's consensus. I think the consensus was right there. I mean, now it's maybe getting overdone, but I think the consensus is right. And whenever that turns against semiconductors, that's generally when I try to get back in. The value investor in me doesn't like things that have gone up a ton. So I tend to get out a little bit early, but I tend to look for dips in those things to get back in, because I think those are real bottlenecks. And so I think there are still plenty of opportunities in the market in the US, globally. It really comes down to valuation and just how solid something is.
Something that's very solid, and I'm just shamelessly going to say that this a wonderful book, Money Without Borders. It's Barry Eichengreen's new book. His book's always fantastic.
He's great. Yeah.
Have you read it, Lyn? His new book?
I've not read his newest book. No.
Okay, so some of the books are a bit more technical. I think this one reads a bit more like I wouldn't say it reads like a novel because I think that's probably because I'm such a nerd whenever it comes to financial history, but it's a significantly easier to read than many of his other books. Anyways, he says in the book, and I'm just going to quote this here: international currency status depends on the issuer's ability to forge durable geopolitical alliances. Central banks and governments hold and use the currencies of their alliance partners. Doing so is a gesture of goodwill. Alliance partners are seen as the dependable stewards of a country's foreign balances. End quote, I should say. Now, to what extent do you think the US still benefits from that dynamics today? And as the global system becomes more fragmented, are we seeing any meaningful changes in the strength of durability of the dollar's reserve status in the current environment?
Yeah, I think, like I mentioned before, we've had decades of these imbalances. And while I do think that the US at one time benefited from having the reserve status, especially during the Cold War, I think it was a massive tailwind. And then even a little bit afterward, I think now the deindustrialization we've had from being the reserve currency issuer is now a bigger factor than how well New York and the government have done by being dollar and dollar security exporters. To the point where, like I said before, even the military is like, why can't we build enough stuff? And it's like, well, that's what happens when you deindustrialize your industrial base, when you produce 1/10 of the steel that China can do, for example. Their economy's kind of balanced the entire opposite way. It's interesting because all those alliances are really important in the beginning and the middle period of kind of growing and maintaining that network. The weird thing is that at a certain point, it kind of takes a life of its own where you have this network effect. And people often refer to the petrodollar. And it's like, okay, if a handful of countries decide to price something else, their energy outside of the dollar, that they could unravel it quickly. But it's actually more resilient than people think because the biggest factor is actually the dollar denominated debts, the cross-border dollar denominated debts. And depending on what measure you look at, there's something like 18 trillion in cross-border dollar loans and securities that are mostly not owed to the US. They're owed to all these different entities around the world. Some entity in Brazil will owe dollars to an entity in China, for example, or some entity in Africa will owe dollars to an entity in Europe. There's a game theory where it's hard to be the first to default. I mean, it's not like it's not like the whole world can just get together and just default on all that and say we're doing a new system now. More like you need a very extreme situation for that to become a real possibility. In general, dollar creditors want their dollars paid back to them, and the dollar debtors, when their bills due, if they're the first to default, they're the one that gets the horrible credit rating and no one wants to lend to them again in the future at any sort of reasonable rate. And so all of that cross-border dollar debt represents inflexible demand for dollars. And that's and that can change over time. I mean, you can, a creditor nation like China can say, okay, here's dollars, pay back your dollar loans, and now your debts are denominated in our currency, right? And we'll give you a swap line, right? So there are piecemeal ways to slowly chip away at that network effect, but they're very kind of long processes. Kind of like how reshoring an industrial base is a really long process. You can't just snap your fingers and say, okay, we're going to produce as much steel, electricity, and manufactured goods as China, or we're going to move that to other countries. It's just, it's way harder and longer than it sounds. And the same thing's true for the dollar system. So yeah, I already think we're in a world where the US, we're in the intermediate term, we can, like right now, we're acting like a wrecking ball, but we don't really see any sort of uptick in de-dollarization because, again, those network effects are very strong. Now, if you do this for many, many years, you increasingly incentivize other workarounds. Like when we sanction Russia, we force them to do business with China in their own currencies, for example. The whole BRICS and Shanghai Cooperation Organization, kind of the China-centered rest of the world, the non-West world, is a growing kind of consortium of bilateral or in some cases bigger moves to de-dollarize payments. And I think the uptick in gold usage is part of that. That's, it's not that Chinese currency replaces the dollar. It's that one, neutral reserve assets like gold gradually replace the dollar as a reserve. And two, that just more payment options than just the dollar exist at scale, which is that if a country's sanctioned, they can still do business in other currencies. And I think those are fully underway. So the dollar kind of gradually goes from becoming like the only game in town to like the biggest, but still a plurality, one of many big options. And part of that is breaking alliances. But part of that is even if we were just a completely nice neighbor, we were nice to everyone, our deindustrialization process still eventually impairs our ability. Because when China has already replaced the US as like the biggest trading partner with the vast majority of countries, that's already a huge factor where they can come in and say, hey, we want you to use our currency to buy from us. And of course, you can use our currency to buy all of the goods we sell you. And we're your biggest customer. We're your biggest trade partners. We want that now. And so there's a gradual shift anyway, even if we were super polite. And of course, us being more erratic or belligerent around the margins can potentially accelerate it, but it's still up against those big network effects.
Yeah, I think it's very important, and it's going to be a theme that we have throughout this episode, that it takes a long time. And like, it's not gonna work like 1, 2, 3, here's a tariff, and now we can produce this widgets. Like, no, like we can't do that. We see something similar with a lot of refineries where it's like, no, we're not getting the sweetness of this crude oil to our refinery, and that's how it's being set up. So now we can't refine it, or if we are, it's going to be super, super expensive because it's going to more or less destroy the equipment that we have to refine the crude in the first place. And so it's kind of like interesting whenever you're seeing all of these things unraveling, and then at the same time, for example, whenever you look at cross-border, even for Chinese trade, how much of that's not in yuan right now?
Yeah.
Like, it's incredible. And you would be thinking, well, like, they're such a big trading partner, they must be doing that with all of their trades. Not at all. And so thank you for painting some color around that. Speaking about great books, I'm sure you're familiar with this one here. I'm holding up to the camera. For those of you who are listening, Lyn Alden's Broken Money. I can't help but continue to speak to you about this wonderful book, you and everyone else. And one of the favorite parts of the book is whenever you talk about Coca-Cola effectively shorting the US dollar and about using leverage intelligently. And it made me think of this wonderful quote from Buffett on leverage. And he says, if you're smart, you don't need leverage. And if you're not smart, you have no business using leverage in the first place. And I love that quote. There are so many great quotes. But of course, whenever it comes to Buffett, one thing is what he's saying, another thing is what he's doing.
Yeah.
And he is the master of using modest leverage. And he's been doing that always. And so more recently, well, in the history of Buffett, more recently, actually some time ago now, but famously, he issued these yen-denominated bonds, and they were close to no cost. And then he, of course, used the proceeds to buy these high-quality Japanese equities. And so whenever you hear a quote like that, you have to think about, like, what is it truly that he means? And we're not talking about using leverage as in credit card debt, 30% interest rate, and then you would go onto your Robinhood account and do, I don't know, out of the money call options expiring the next day. That's not at all what we're talking about here. But my question to you, Lyn, is how do you short the fiat currencies in your own portfolio? And how do you think about using leverage to enhance your real investment returns, if any?
Yeah, good question. So yeah, I operate fairly unlevered. I occasionally use leverage, but for the most part, I look for other entities that are using it effectively. One of the things I've said before is that the best product that Coca-Cola or Procter & Gamble ever sold was their bonds. Or another way of looking at it is Coca-Cola's been around for over a century. They're almost always profitable. They've been profitable longer than we've been alive. Why do they have any debt? Why do they have $40 billion in debt? And the reason is because they can. It's an arbitrage. When, especially pre-COVID, before higher rates, they could borrow at 3% for 30 years or 20 years. That's basically shorting the currency. And whenever you can borrow at a rate that is much lower than money supply growth, so if dollars are growing in supply by 7% a year, and you can borrow at 3% and lock in that rate for a super long time, you can use that money to buy scarcer things, including your own stock, an acquisition, more equipment, real estate. You can buy all these things. And so really the winners of the system, of the kind of the fiat system over the past, call it 40 years, 50 years, is those who short the currency in a safe enough way that they don't blow up during recessions. So they're not the most levered, but they're structurally cautiously levered while owning very high quality stuff. And Buffett, he uses kind of two layers of leverage. One is simply by owning equities. He's benefiting from that because equities are already doing that. Coca-Cola is already doing that, for example. Apple's already doing that. Apple just famously didn't have to issue a ton of debt, but it was the most attractive bond in the world. So it just issued tons and tons of debt, bought back its own shares. And it was a huge gain for Buffett's portfolio, Berkshire's portfolio. Same thing for Coca-Cola, same thing for many others. So he owns equities that are doing this game. Structurally short fiat currency, owns scarcer things. And then two, because he smartly got into the insurance business, it's one of the best decisions he's ever made because insurance is one of the best types of leverage. The whole point is you take in premiums and then you owe payouts along the way and you're holding this float. Unlike a bank deposit that can pull that at any time, your holdings kind of locked in leverage, and you can invest that leverage and get a return on it. And most insurance companies will buy a bunch of bonds and make 4%. And Buffett will, he'll own enough bonds to have low enough volatility, but then he'll go out and buy blue chip stocks. So he's buying entities that benefit from leverage in their own right. And then he's buying them using like insurance float leverage on top of it. So he's got this very cautious two stack of leverage that is very resilient to most crises. And then occasionally, like you said, he'll go out and make other idiosyncratic leverage decisions. So those Japanese trading companies that he bought, they themselves were already quite levered in a good way because they're borrowing yen at near zero. They own scarce assets. They own like commodity deposits and convenience stores and supply chain logistics, things. They own all these hard assets. I'm still long those. I bought those years ago too. I didn't do it on leverage because I just benefited from their own leverage. But so he buys these things that are leveraged, but then further, because he's Berkshire and he can do really big things, he can borrow a ton of yen at low rates and then buy these entities that are themselves leveraged, kind of like the insurance float situation. So that kind of two stack of leverage, when applied prudently, is how he's kind of made his fortune. I think going forward, it's a little bit harder because now we're no longer at a 40-year period of falling interest rates. So when you have 40 years of falling interest rates, you have kind of prices of everything kind of structurally go up. Interest rates keep going down. You can keep refinancing at lower and lower rates. When interest rates are kind of flat, like choppy sideways, and asset prices are maybe no longer as structurally up as they were before because they're already at higher valuations because they've already benefited from rates going all the way down, it's less clear of a thing. Like I think it'd be even harder for Buffett to do it over the next 40 years than it was over the past 40 years or 50 years. But it's the same general principle still applies. Like in my personal life, for example, we got a house. We didn't need a mortgage, but we're like, if they're gonna let us borrow at 3.5% for 30 years, do I think my investments, like, should I sell equities? Should I sell things that I think are going to do better than 3.5% to just buy this house free and clear? No. And the same thing, we have an Egyptian property. Money supply there is growing by 20% a year or so, and we could borrow the equivalent of like 4%. It's like, all right, we'll make that. It's like a 7-year deal. And it's like, I'll short the Egyptian pound for 4% a year for 7 years, if you'll let me, instead of having to sell equities to buy that property. So that's kind of the only place I use. I use kind of like real estate tied, low interest rate, non-callable leverage from time to time. But for the most part, I let my equities do it for me.
I have to double click on what you said there. You're paying the equivalent of 4% in Egypt on a property?
Yep.
That's unbelievable. Wow.
Yep. Yeah, their whole mortgage structure is different. So it'll be structured so that it doesn't look like an interest rate, but you can calculate what the effective interest rate is. So it's basically saying, okay, you can buy this house for this pound amount today, or you can do this 4-year payment term, or this 5-year payment term, 6 or 7-year payment term, and these are what the payments will be. And when you kind of just do the math, then, okay, all those payment, you get your spreadsheet out and you see all those payments. You say, what effective interest rate am I paying then on all those payments compared to just buying the house lump sum? And in our case, it came out to under 4%. So I'm like, well, I'll take the longest term you'll give me then, because and the Egyptian pound's growing by 20% a year. And of course, they kind of temporarily, kind of artificially peg it to the dollar from time to time, but then those pegs break. So, yeah.
Wow, that is fantastic. Thank you for sharing. I hope the listener don't take away from this episode that they should not use leverage and it's only Buffett who can do it, but also don't hope they leave here and like, oh, I need to I need to take on debt and invest in all kinds of stuff. I think the takeaway I want to give people is they really need to understand currencies. That's where it all starts. And I'm shamelessly going to say, if you really want to understand currencies, you need to pick up Lyn's book, Broken Money. Perhaps you also need to pick up Lyn's new book. I really wish I could advertise that here, but you're doing that perfect.
Oh, yeah.
Yes. And what's the name of the book, Lyn?
The Stolgard Incident, sci-fi thriller.
Wonderful. And so I really wish I could advertise it here on the video if you're following along the video, but I ordered it as soon as it came out. This is a bad advertising for the German Amazon. It takes a month for the book to arrive, so I still haven't gotten a chance to read it. But I want to weave a bit of investment into my next question here about the book, because I often find inspiration for my investments in the most unlikely places. I'm curious if you learned anything new about investing from writing your new fiction book, The Stolgard Incident.
It's an interesting question because I'm not sure I learned anything new about investing, but I think I learned new about technologies, right? So the engineer in me wants to try to make things realistic where possible. I'm not like fully committing to like hard sci-fi, for example, but when I extrapolate what a society could look like 50 years from now, which is roughly the setting of the book, I inevitably have to go through an exercise of thinking, okay, what does the world look like in 50 years? What technologies kept expanding it at what rate? What technologies hit ceilings and maybe stagnated? For example, like, if you look at like the Jetsons or just any sort of visions of the future from decades ago, they thought our aerospace capabilities would be way better today than they are. Instead, what happened was we ramped up our aerospace capabilities dramatically, and then we kind of hit a wall. Like we had the Concorde, and we don't have that anymore. They used to be shorter for civilians to get from the United States to London than it is now. We never really could find a way to make that economic and safe. And we kind of hit these like hard limits. And maybe eventually we can pierce past them, but it's not like a linear improvement. With aerospace, it's like once we had the combination of hydrocarbons and aluminum, we kind of fixed thousands of years of like not making any progress on flight. We made all this progress in the span of one human lifetime until we ran into a ceiling. And then we've been kind of only incrementally better. Like the electronics in planes get better. We added wingtips, but for the most part, a plane today looks the same as a plane from 1960. And as kind of part of writing the book, I was okay, what things keep getting better? How dense is computing in that? Do we run into kind of fundamental computing limits? How good does AI get before it kind of runs into certain limitations? How dense can batteries become in that time? What will those batteries look like? What types of energy are people using? Is it economically flourishing or is it economically stagnating? And if so, what's the wealth concentration look like? So I think it was more an exercise of seeing kind of the comparative rate of technological growth, which then can influence investing more so than directly coming up with like investment ideas from the book, if that makes sense.
I love that. It makes me think of the Peter Thiel quote, "They promised us flying cars, and all we got was 160 characters." And, I know that's probably a bit extreme to think about it like that, but you bring up such a good point. Like we used to get around faster than what we do today. It's kind of extraordinary whenever you think about it. Lyn, this has been amazing as always. I have now for the fourth time told people to go out and get broken money. I'm also going to say, make sure to check out Lyn's blog. It's absolutely amazing. I print it out every time that there's a new edition, and I'll sit there with my highlighters like, oh, this is so insightful. It's unbelievable. So still, I don't know if I've advertised your content enough, but Lyn, if you have anything you want to point people to, please do so.
People can check out lynalden.com, Broken Money, the Stolgard incident. And thanks for having me on. Always happy to be here.
You bet, Lyn. Thank you so much.
Thanks for listening to TIP. Visit theinvestorspodcast.com for show notes and educational resources. This podcast is for informational and entertainment purposes only and does not provide financial, investment, tax, or legal advice. The content is impersonal and does not consider your objectives, financial situation, or needs. Investing involves risk, including possible loss of principal, and past performance is not a guarantee of future results. Listeners should do their own research and consult a qualified professional before making any financial decisions. Nothing on this show is a recommendation or solicitation to buy or sell any security or other financial product. Hosts, guests, and the Investors Podcast Network may hold positions in securities discussed and may change those positions at any time without notice. References to any third-party products, services, or advertisers do not constitute endorsements, and the Investors Podcast Network is not responsible for any claims made by them. Copyright by the Investors Podcast Network. All rights reserved.
So in some ways, losing dollar dominance is not a bad thing. I think the bad thing would be losing it while trying to gain it. If you do everything in your power to maintain it and it gets taken away from you, that's kind of like you're pushing into the wall and the wall vanishes. It's better to start easing away from the wall